Hello, everyone, and welcome to our podcast, All Matters Financial. And today's topic is on estate and trust planning. Our guest advisor today is Becky Williams. Becky, would you just like to tell us a little bit about yourself?
Hi, thanks, Stuart. Obviously, my name's Becky. I'm an independent and chartered financial advisor working at Pareto. I've been advising clients for 10 years, but probably been in the industry in excess of 15. I don't tend to say or sort of advertise the fact that I specialise in any particular area, but I tend to get involved with people that have been or are successful in business, whether that's in an employed capacity or in a sort of a self-employed capacity, whether that's via a limited company or not. And so I tend to deal with people that have a broad range of financial planning needs, and so inheritance tax planning is definitely one of the areas I get involved with.
Good, thank you for that, Becky. So, in terms of estate and trust planning, what exactly do we mean when we're discussing estate and trust planning?
Estate and trust planning is about passing wealth on to future generations, or whoever you might want to pass wealth on to, tax efficiently over a period of time.
Okay, good. And why would you say looking at estate and trust planning is so important?
It's important because we all have what's called a nil rate band, and we all have an amount of money that we can pass on to whoever we want to in the event of death without any tax charges applying. And that amount is £325,000. And we can also potentially pass a proportion of the value of our property onto those people too. But anything in excess of that is subject to a tax charge of 40%. So a married couple, for example, passing wealth on to their direct descendants can potentially pass on £1 million without deduction of tax, but anything in excess of that amount is potentially subject to 40%. So it's really important to understand the position you're in, particularly given that these allowances have stayed static for a very long period of time, and property values over that period of time have increased significantly. So this tax has caught more and more people over the last probably 10 to 15 years.
Yeah. And I think it's fair to say HMRC receipts last year is the highest that they've ever been with regards to inheritance tax, and the income coming in from that is over £7 billion.
Yeah, exactly. And there are things that people can do to plan for it. So, yeah, it's important to understand the position you're in, because you might actually be caught by it unwittingly. And understanding the options that are available to help you address it are important, because you'll need to know those in a timely. You need to know what those are in a timely way.
And what are some of those examples of the options that are available to clients to look at mitigating the tax?
Well, very simply, there's two ways of managing an inheritance tax liability. One is to gift capital away, and the other one is to fund it via an insurance policy. And there's various ways you can gift capital away, but the simplest way is via what's called a potentially exempt transfer in the inheritance tax world, which basically just means an outright gift to whoever you want. And in this country, we can gift an unlimited amount of money outright to whoever we choose, without there being any immediate tax charges in lifetime. So it's actually quite a flexible regime. But the issue you've got there is that the beneficiaries of people who you gift money to then have 100% control over the capital, which can sometimes be an issue if matrimonial issues are involved, and can also be an issue if that beneficiary isn't financially ready to receive funds. So if they're either financially irresponsible or perhaps just financially unaware, it might not be appropriate to gift money outright. So the other option is slightly less tax efficient but confers more control, so there's still a benefit, and you might want to think about gifting money into trust. That is considered in the inheritance tax world as a chargeable lifetime transfer. So anything that gets transferred into trust is subject to a 20% tax charge on the value in excess of $325,000, and there's potentially tax charges on an ongoing basis. But it's still an effective way of both managing inheritance tax, but more importantly also controlling how and when your beneficiaries receive funds. And for a lot of people, that is very, very, very important and can be a bit of a barrier to addressing your inheritance tax problem. And I mentioned funding it. You could very, very simply look at an insurance policy with a sum assured equal to the value of your notional inheritance tax liability that will be paid into trust in the event of second death, and that is then used to satisfy the tax bill.
And I think it's important to recognise that inheritance tax will constantly change, so it's worth reviewing that on an ongoing basis.
Yeah, I mean, the review of inheritance, so planning for inheritance tax should happen on an ongoing basis and shouldn't happen in isolation of any other planning area, because it can impact, for example, people's ability to retire. You need to understand how much you can gift at any one particular point in time without putting yourself at risk. But as you said, Stuart, asset values grow significantly over time. You can't just put something in place once and expect it to remain relevant for the rest of your life. So yeah, it should be reviewed on an ongoing basis, along with every other aspect of financial planning.
And you mentioned pensions there. I think what we're finding is a lot of our clients are using pension planning as an inheritance tax mitigation tool.
Yeah, it's one of the most effective ways of managing your own wealth in an inheritance tax friendly way. And the reason for that is that pensions aren't assets that are counted when you in the event of death, when you're looking at the inheritance tax position. So they don't fall into the calculation for inheritance tax purposes. A different set of rules apply. So in the event of death before 75, an invested pension can pass on to your nominated beneficiaries tax-free. And then after 75, those nominated beneficiaries can still receive the funds, but unfortunately at that point they'd be subject to a marginal rate of income tax, but they can control when they receive those funds. And indeed, if they don't need the funds, they can pass those on to future generations too. So preserving value within your own estate, within a pension environment, is a very, very, very inheritance tax friendly way of managing your investment portfolio. And so what we've seen certainly since 2015 in these rule changes is that a lot of people are using their investment portfolio to help support income before they would look to take benefits from their pension fund, which seems a little bit contrary to people's expectation.
And obviously you've still got your annual allowances, because the government do give us all specific annual allowances that we can use on an annualised basis to mitigate inheritance tax and gift capital away.
Yeah, so I mentioned outright gifts were considered potentially exempt, but actually if that gift is within a £3,000 limit each year, then actually they're just ignored. So you can give away £3,000 a year to anyone and it's almost like it never ever happened. And that's really useful over a period of time for those people that are quite young and have children and want to help them for their future, want to help set up an investment or something like that, because effectively what you're doing is moving small amounts every year out of your estate. The growth is then not your own, and yeah, it's completely ignored for inheritance tax planning. So it's a really effective way of helping your family. And the other thing to consider is that gifts can be made out of regular income, provided they satisfy certain criteria. And as long as those gifts are sort of regular and habitual and meet that criteria, then they're also ignored. They're not potentially exempt, they're not a chargeable transfer. And so there are things that you can do really simply quite early to manage this inheritance tax position.
So you mentioned that there are things that you can do, and you mentioned looking at these as early as possible. When should clients actually start looking at inheritance tax planning, Becky?
I think whenever you are sort of starting to get close to breaching those notional allowances, it's important to have a think about quantifying your own position and asking yourself consciously whether you should or shouldn't or do not want to do something about it. at that stage. And so for a lot of people, that will happen at different ages. Typically, it happens as we get a little bit older, but it's not always the case.
Okay, good. And obviously, you mentioned different people should start to look at doing this, but I think it's fair to say inheritance tax is not just a tax on the rich now. I think it's fair to say that with our clients, everyone should start to look at just reviewing this aspect of their financial needs.
Yeah, I mean, I think because, as we've mentioned, these allowances, the nil rate band, which is typically the allowance that has been used for decades to support people giving wealth away, that has been frozen since 2009. So you can imagine what property prices have done in the meantime, as and you know, the inflation debate is covered extensively in the press at the moment. So in real terms, that allowance has fallen significantly over time, which means more and more people are being caught by the inheritance tax charges that apply. And I think reviewing your inheritance tax position is very, very important for that reason. But it's also important to review it properly, because you don't want to give away something too soon. And I think the more of us that get caught by this inheritance tax planning problem, perhaps the more of us might want to do something about it. But you also need to consider how much capital you need in lifetime before you actually affect any kind of inheritance tax strategy, because you need to think about what you're going to need in your own life and how you want to help your children, whether you eventually want them to inherit a legacy in the event of death, or whether you want them to have a little bit more money earlier on, because that's when ultimately your kids are probably going to need help. And then you need to think, well, you know, given the risks around gifting early, how do we protect those gifts? And that's where a good financial planner can really support you, because you can talk around the issue. And what's really important to understand is what your position is, but also how and when you want to help your family and or anyone else in your life. You know, that's the important bit.
So I think there's various considerations that clients need to take into account.
Yeah.
Good. Well, thank you. Very thoughtful and thought-provoking. So in summary, Becky, would you just like to summarise what you would say maybe the top 3 or 4 points to our clients with regards to inheritance tax plan?
Understand what your inheritance tax position actually is, because there are a lot of allowances, exemptions, and other assets that maybe don't qualify for inheritance tax that you need to take into account. So that's really important. Then I would think about how I wanted to help my family, or whoever it is that you ultimately want to benefit from your estate. What are the issues there, and how do you want to address them, and when? And then the third one would probably be take advice. It's really complicated inheritance tax, and you can trip yourself up very, very easily. And you don't want to get in a position where you've done something and it's not quite worked out. It's not worked out the way you wanted it to work, because that would just be a poor out. Yeah, so seek advice would be the last one, I think.
Good, thank you. Just on the random question part of the podcast, if you could do anything and money was no object, what would you like to do?
Oh, I would. I used to play a lot of lacrosse when I was younger, and for those of you that don't know, lacrosse is played extensively for the girls in private schools, but up north actually, which is where I'm from, it's played a lot in the clubs. And up north, yeah. It's played a lot in clubs, all run by volunteers. And sorry, I digress, but the reality is, what I have experienced over my lacrosse playing career is that sport is an amazing way to help support kids through lots of different backgrounds, sort of gain an education and access to opportunities, or provides access to opportunities. So I think what I'd actually like to do really is work for, or be part of, or set up, or help run some kind of charity that promotes those values. So certainly doesn't let people get away with having handouts, but gives people the opportunities through sport to develop themselves where perhaps they wouldn't have had that opportunity elsewhere.
Good, thank you. I'm sure everyone will agree a truly worthy cause. So this podcast is part of a series that Pareto have recorded. I would ask any listeners to subscribe and check out our other podcasts on different subjects such as protecting your assets, retirement planning, growing wealth, cash flow planning, protecting businesses, employee benefits, and helping to exit businesses. As always, the information provided in our podcast is general in nature. As Becky said, this should not be relied upon without seeking professional financial advice. It goes without saying, if you'd like to speak to anyone at Pareto regarding your personal circumstances on a fee-free, no obligation basis, then please feel free to contact myself, Stuart Carswell, or your advisor at Pareto. Thank you for your time.